Hello, good afternoon. Welcome to MF Corner on CNBC TV 18. I'm Vinnii Motiwala, and thank you so much, as always, for tuning in. Now, it is often assumed that profiting in a bull market is quite simple. Nevertheless, it becomes difficult to both make money and stay in the market when times are hard. To strengthen the emphasis on creating a robust portfolio, it is essential to possess a well-defined strategy along with the ability to think critically and make informed decisions. To know how to do that and how to go about this as well, and how to build wealth through mutual funds in such a tough market, we're joined by Nasser Salim, Managing Director at Flexi Capital, to talk to us about how we should go through this uncertain time, how should we start approaching our mutual fund portfolios. Nasser, good afternoon. Thank you so much for tuning in, as always, with us and joining us on the show. Tough times. Market is so tough to judge right now. Every day is a different story, right? One day you see those sharp cuts coming in, the next day it's up again. And due to this volatility, there are a lot of factors that we've seen, right? Whether you talk about inflation, geopolitical tension, economic uncertainty, and the main thing coming in terms of those Trump tariff issues and global trade war is a major concern. But as a mutual fund investor, how should I start approaching my mutual fund portfolio, building it if I'm starting it right now in such a challenging time?
Good afternoon, Vinnii. Thank you very much for having me back on your show. Yes, no doubt, April 2025 has seen outsized market swings, which continue, which are attributed to plenty of triggers: inflation, interest rates, geopolitical turmoil, Vinnii, and the tariffs have obviously continued to play havoc, which is the biggest role in the current downturn. I think to answer your question, very, very simple. We keep going back and discussing this is BAU. Stay anchored. All MF investors today need to stay anchored to long-term goals and objectives and avoid knee-jerk reactions. Simply, Vinnii, because, once you wake up in the morning, there's a statement by the president of the US, something goes wrong. You wake up, you should not move away from your long-term objectives and goals. That's number one. Number two, I think very, very important. Diversification is a very, very important. It's only it sounds like it's a word, but it's very, very important. And more so, I can tell you this with 20 years of experience. Diversification actually plays out a key role, the crucial mix between various assets that behave differently. So not all investments fall together. A prudent approach, Vinnii, is good to consider in uncorrelated exposures, whether it's in precious metals or, for example, gold or silver. I mean, we've seen gold run up in the last few quarters, done really well. Maybe it's silver now, and fixed income alongside your equity portfolio. So diversification is number two, very, very important. The other quick one, without wasting too much time, is on equities as an animal. It runs on volatility as its feature. Rupee cost averaging through regular investments can further temper the impact of fluctuation. So I think stay invested despite noise. History has shown that rebounds eventually follow downturns. In short, keep calm, stay diversified, and stick to your plan.
Keep calm, stick to your plan. Diversification is the key. I want to ask you on diversification, because we often talk about diversification to manage the risk, right? You were talking about it right now as well. Could you elaborate how investors can effectively diversify? Because there are a lot of asset classes, right? You were saying about gold, silver, other commodities, equities is there. But there is much more than that, right? We have those debt funds that come in, international funds that come in as well. So how to go about that then?
See, very clearly, diversification effectively means having a basket of assets whose returns are not completely dependent on the same factor. I think that's the key. And thereby offering downside protection in times like this. I think in practice, usually spreading investments across equities, fixed income. Today, a lot of our discussions should be around fixed income, asset allocation. Very, very important. International funds, precious metals, and even real estate. I mean, why when you're looking at mutual funds, we don't talk about there are REITs available, there are mutual funds available investing in through real estate REITs, which give you participation. And each asset shines at different times. Equities drive growth, bonds provide stability, especially with high interest rates boosting yields. Now we're looking at the RBI MPC meet, which may come up. Precious metals, hedges against inflation, and international funds reduce home country risk, in my opinion. I think dividing the equity portion into a core and satellite, something which all MF investors should talk to their certified experts about, can provide further inter-asset diversification. The goal is to ensure that no single event causes major drawdowns in the portfolio.
Right.
That's the intent of diversification.
Absolutely. So it's not that one particular event will lead to a fall in your whole portfolio, and that's why diversification is key. And you mentioned how each of these other asset classes have their own benefit or what they provide as well. But, Nasser, just talking more specific now, what role does dynamic asset allocation play in navigating uncertain markets? And are balanced advantage funds a good choice for retail investors at such a time then?
Absolutely, Vinnii. We've been clearly, saying this proactively at every platform that hybrids, especially for first-time investors who are starting their journey into equity as an asset class, should be exposed to hybrids. The world of hybrids is very interesting in today's times. There are many schemes that I was looking at this morning which have fallen. When the index fell by 4% yesterday, they've fallen by 0.2 or 0.25. And that's where the beauty of hybrids come in. So something like a dynamic asset allocation strategy lets your portfolio automatically adapt to market conditions by adjusting exposures based on prevailing market conditions. You mentioned about BAF. It's a very popular category, has grown since it's been launched. BAF exemplifies the shifting between equity and debt based on market valuations. BAF also reduces equity exposures when markets are higher and buy more stocks after corrections, aiming to buy low and sell high, which is the fundamental approach to investing. I think some of these BAFs suit retail investors wanting equity-like growth returns with some downside protection. So effectively juggle between risk and reward. That's a very key factor that a BAF plays. I think also please do remember that BAF also carries equity risk as an asset class. They can't eliminate volatility or guarantee gains. However, they are used to for mid to long-term horizons as part of your portfolio. I think the other very quick one is dynamic asset allocation strategy, which is, in addition to BAF as a category, it takes emotions out of investing. Vinnii, I think that is something which we need to kind of now play out and systematically navigate interest rate swings and global jitters by automatically rebalancing to safer assets when needed. So both hybrids, in the world of hybrids, BAF and dynamic asset allocation funds have moved really well.
Absolutely. Nasser, there are so many macroeconomic events that happen as well, right? Now, obviously, we do have RBI's decision that is tomorrow as well. We'll have the Feds coming up as soon as well. So all these interest rate hikes or cuts, whatever may take place, or even in terms of inflation data points that you keep getting every month, how do these impact different asset class? And, is there a way that one could go about playing this as well, right? Because what if there's a rate cut that comes in? What should one keep in mind at such a point of time? And what should they be doing in such things?
So very interesting economic question that you've posed, Vinnii. And the answer is, interest rates and inflation affect each asset class differently. They can never be the same. For example, when rates rise to combat inflation, bond prices fall. Yields go up, but existing bond values go down. New investors, for example, can benefit from higher fixed income yields. Equities, on the other hand, may feel pressure too. High rates increases borrowing costs for corporates, for people who wish to borrow and leverage, and slow earnings growth, often hitting rate-sensitive sectors like realty or autos, for example. I think, on the other hand, gold, we've seen we've seen a sequential gain quarter on quarter, tends to shine and amid high inflation and geopolitical stress, which we've noticed. Investors saw gold outperform in 2024's volatile patch, as evident last year. Meanwhile, real estate and REITs can offer a hedge if rents keep pace with inflation, but rate hikes may soften property prices also. So look, there is never one particular formula, but being aware of RBI's signals, I think a potential rate cut, which you just said, is imminent, if possible, if inflation cools, could boost stocks and costs and bonds. Investors should adjust, not abandon. Example, favor shorter duration bonds in rising rate regimes. Look at quality scripts with pricing power during inflation and maintain some gold. Precious metals, for example, now it seems that data suggests that between gold and silver may be a little more prudent as an option that can be looked at for shortlisting. So some of these as a holistic approach should be considered. given inflation and interest rates.
Absolutely. So keeping all this in mind, watch out for the signals that, Nasser mentioned as well. And, what we can do at such a time as well, if there are interest rates that come in or what happens in terms of inflation data points. Nasser, today when you look at it, the world is so interconnected, right, with each other. There's so much that's happening. How important is it to have that international fund or exposure to global equities in one's portfolio? Because you don't want that risk to come in only if there's a problem with the domestic front. Then at least you have some exposure on the international market. Or if there's something on the international market, you have something supporting you in the domestic market.
Well, in today's point of time, I would, the mandate is changing a bit. We're trying to get away from an interconnected world. But I great question again there. I think, international funds allow Indian investors broadly to own US, for example, US tech giants, European blue chips or Chinese innovators, spreading risk beyond the home market and economy. I think over the past year, data is available. Global equities have outperformed domestic during Indian markets downturn later in the year. International funds, for example, have averaged about 40% versus single digits for many Indian equity categories. I think the underscore value is when Indian markets tumble, global markets may rally and vice versa. I think that's the fundamental point. Including a healthy exposure up to 20% in international funds mitigates India-specific risks, like a policy change or a local slowdown that may happen in some other economy, and captures growth from leading global trends. Today, we're talking about renewable energy, AI, EVs in the world. I think some of those, if it also hedges against rupee depreciation over the long term. I think the key is to choose established international funds, or ETFs for that matter, which are aligned with one's strategy, whether it's the S&P 500 index, for example, or a global multi-asset fund. It allows you to build a more resilient portfolio that's in tune with global opportunities and your individual risk-adjusted risk profile score. So I think that's something which is very important.
Okay, Nasser, thank you so much for that update there coming in on international funds. But we still have a lot more to discuss. We're going to slip into a short break and come back and discuss those other points with Nasser as well, so don't go anywhere. Welcome back to MF Corner on CNBC TV 18. Today we're discussing what you should be doing in a volatile market to keep a good mutual fund portfolio for a long term. What are the steps you should take? What is the risk you should avoid as of now as well? And we still have Nasser Salim and Managing Director at Flexi Capital, who's still with us. Nasser, let's keep the discussion going on. And SIPs, that's popular way to invest in mutual fund. Everyone, we keep saying SIP is the right way to go ahead. You're talking about rupee cost averaging as well. How do they help in wealth creation? If you could explain our viewers why it's necessary to go through this process as well, and especially in this volatile market.
So three key things, Vinnii, as far as SIPs are concerned. They are best friends of investors in choppy markets, all that I can say. They enforce discipline, investing a fixed sum of money monthly or quarterly into mutual funds, regardless of market levels. That's number one. I think clearly, the rupee cost averaging formula, which automatically buy more fund units when prices are low and fewer when prices are high, lowering the average cost is something which is a fundamental attribute to the SIP model. The other very, very important point is that you're less likely to panic, sell, or stop investing in a slump, which is when opportunities are greatest. In fact, continuing SIPs during crashes lets you accumulate units cheaply, which is currently what we are seeing, which reflecting during the recovery. When things recover, you all of a sudden see you accumulate a large number of units and start reflecting better in terms of return profiles. I think, moreover, compounding works better with early regular investments, Vinnii, and each SIP installment can grow for years. Investors use SIPs for goals like children's education or retirement. They could also build wealth steadily without trying to time the market as such. I think the other very, very important is that it automatically removes any emotions that get attached. SIPs also just removes emotions from investing. I mean, you have no control over it. I may feel today I want to sell because there's negativity, there's a lot of red in my portfolio. But guess what? I mean, you can still do it, but an SIP is a discipline. It gets you in. So I think the key is to stay invested through cycles, and SIPs helps you achieve those.
Absolutely. Key is to stay invested, but Nasser, you're saying, like, it puts your emotions away as well. But sometimes, when you just started your SIP, maybe just this year, beginning of the year, and now you see that negative coming in even in SIP front, then it does worry anyone. Like, okay, am I going the right way, or have I picked up the wrong fund? How does one judge that then?
So clearly, we're assuming this is a group which has done a proper study before you're investing, and you've chosen your shortlisted your SIP funds, and you've used certified experts to solicit those funds that are being invested by you or by the investors. I think clearly, as long as your objective and your end need is to ensure that you're creating wealth, and you have certain triggers which are the reasons for shortlisting of those funds, which can be reviewed once in 6 months, perhaps, or maybe once in a year at best, to see if those short-term and long-term triggers were the reasons for choosing or shortlisting a fund. Is the reason why you should continue to hold. You should continue to hold. There is no reason for one to sell. And for newer investors, I think something which is very, very important is don't try to time the market. It's what determines is when you stay invested in the market. Time spent in the market that will determine your returns through SIPs, not by timing the market. It's never worked, Vinnii. And in our opinion, attribution analysis, when you're looking at shortlisting funds on SIPs that have been chosen by you or by your certified experts, review once in 6 months or once in a year to see if those attribution analyses remain still within the goal that you've chosen them, and therefore you remain invested. Else, you can look at some options where you need to consult and then change.
Okay. Nasser, so many options that we have in mutual fund categories, equity, debt, hybrid. You can go on and on talking about the options that are there. So how should investors choose the right fund right now based on the financial goals? If I have a long-term goal and my risk appetite, what is it that one should be, how should one judge that?
So, these are time-based, objectives and investments that one gets to kind of choose from. Selecting a fund, Vinnii, depends on one's objective, risk appetite, goal. Equity funds suit long-term goals, for example, clearly nothing less than 5 years, bare minimum 60 months, and a higher risk tolerance. There is a riskometer by SEBI that is available on every given SID. And I want your investors, viewers, to kind of ask their certified experts to show them what a riskometer is for their fund. They offer growth, but with a relatively higher degree of volatility. Within equity, we have large caps, which are relatively stable, while mid and small are much more volatile, but potentially more rewarding. Debt funds fit short-term goals or low-risk profiles. Think of liquid or short-term bonds for parking money safely. There's a category called arbitrage now, which is very, very popular. Then there are corporate bonds, gilt funds for steady income with moderate risk. We're also seeing now a very interesting set of funds where some large asset managers have launched something called arbitrage plus income. So it's a combination of debt plus arbitrage, and it also gives you a capital gain advantage over 2 years of holding period. Hybrid funds like balanced or aggressive hybrid, we just spoke about them. Blend equity and debt, giving a very mid-path approach. For example, an aggressive hybrid fund can invest up to 70% in equity as an asset class, 30% in bonds. Can be an ideal for a moderate risk investor seeking growth with some cushion. For a 1-year goal, an equity fund is too risky, so opt for debt. Our recommendation for 10 years plus pure equity or equity-oriented hybrid might be apt. So also assessing one's comfort and volatility, their risk appetite is integral to portfolio construction.
Absolutely. Nasser, what is important right now also that sometimes when the market is going down, you do need some emergency fund as well. So what is your advice to an investor who's just starting off in terms of emergency funds? And why is this step so critical in financial planning as well?
It's a very, very important question, Vinnii, and I'm so happy that you're raising this question. I think the importance of emergency fund in all our lives happened when we got hit by COVID in 2020. I think building an emergency fund is very, very important to one's discussion and portfolio construction. Before you even invest in any mutual funds, it is recommended to shortlist and set aside an emergency fund. This can be ideally for 6 to 9 months worth of living expenses, which should be parked in safe assets, liquid stroke arbitrage, which are available within 24 to 48 hours of on call. It's the financial cushion for any job losses, medical exigencies, emergencies, unexpected home repairs. It prevents you from dipping into your investments at the wrong time, Vinnii. If a sudden need arises and you've invested all your money in equity funds, you might be forced to redeem during a market crash, locking in losses. An emergency fund ensures your long-term investments are not touched and in through uncertainties, so they can compound continuously, uninterruptedly. And it also grants peace of mind. I think the most important thing is if you have a set-aside budget or a bucket which is available for 6 to 9 months, Vinnii, it gives you peace of mind, knowing that you have a safety net. You can invest in volatile markets more confidently and avoid panic selling for cash needs.
Absolutely.
And typically emergency funds are kept in high interest savings or short-term, fixed deposits or liquid arbitrage assets. In this case, as far as mutual funds are concerned, that won't drop in value when you need them.
Okay. And Nasser, a quick one. What are some of these common mistakes an investor makes while building the mutual fund portfolio, and they should avoid, especially at such an uncertain time?
So again, a great question, right time, Vinnii. I think in turbulent times, investors often become their own worst enemies, if I can say this on your show. A few frequent mistakes that one can avoid. Panic selling starts off with that. Watching your fund values daily, hourly, every minute, it can be disrupting and can induce panic selling and convert paper loss to real loss. So markets eventually recover. And if you exit, you might miss the rebound. So please do not look at panic selling. Trying to time the market perfectly, Vinnii, waiting for the perfect entry or exit rarely works. In my last 22 years, I can tell you, I have not seen it work. It often leads to disruption, buying high and selling low. A better approach is sticking to a plan and following it consistently with an asset allocation model. Lack of diversification is another mistake that we all investors end up doing. Putting all money in one sector or fund, say all mid caps or all small caps, can backfire. Ensure a mix of funds across different market caps, asset classes. Also avoid over diversification. Ignoring risk profile. I think that's again something which is very, very important. Somebody may have come and told you that, listen, I'm invested in this particular fund. It could be suitable to that particular investor, but have you done your own risk profiling?
Yeah.
Chasing high returns, of small cap funds or past performances does not guarantee any returns. And it's subject to one's risk tolerance. Align investments to what you can stomach in terms of losses, nothing beyond that. And the last one is just people who don't stay calm. I mean, it may seem frequent tweaks to the portfolio are necessary, but high churn is known to hurt performance in the long run. Stay the course, viewers, review periodically, and adjust only if your goals or risk appetite changes in the process of investing in the journey. By sidestepping common errors, especially in uncertain times, you set your mutual fund portfolio up for long-term success. Those are some of the mistakes that I think one can control.
Absolutely. I think then it's the right time with that advice coming in and mistakes to avoid. So thank you so much, Nasser. We'll wind down this edition of MF Corner on CNBC TV 18. Thank you so much, viewers, for tuning in as well. It's always a pleasure to get you all more details in terms of what to do in mutual fund. And up next, you have Closing Bell, so don't go anywhere.